The 360 on Energy and Carbon, hosted by 360 Energy. On today's episode, we are joined by Stephen Schork. Stephen Schork is a highly acclaimed speaker who is widely recognized for his ability to integrate vast arrays of compelling information into dynamic and succinct market views. His presentations include overviews of the most pressing issues affecting the energy sector and context within which to evaluate market action. Now let's get into the episode with Stephen. Welcome back, Dave and John.
Great to be here.
It is wonderful to be back, and I can't wait to listen to our guest speaker today. It's going to be great.
Here.
Today we are joined by principal and co-founder of the Schork Group, Stephen Schork. Welcome, Stephen.
It's great to be back. Thank you.
Today we're talking about navigating the energy markets in 2024. With the current energy market volatility, what are some key trends you're observing right now, and how do you see these playing out in the near future?
First and foremost, the two things that are really impacting volatility are one, of course, geopolitical, with the ongoing war with Russia and Ukraine, the situation with Iran, the war that is picking up steam now in the Middle East, and China. So let's begin with Ukraine and Russia. So that's obviously impacted more of the European gas markets than it has the US markets. It did have a temporary impact, but keep in mind there's a limit to how much gas this country can export at this moment. So any gas that is going to Europe to offset the loss of Russian gas is already being spent. So therefore, there is an upside limit to that. The big concern, the elephant in the room, of course, is the ongoing and escalating war between Israel and Iran. And let's be clear on this, that this also, of course, involves the United States and the West. So we've already seen a significant disruption to the flow of oil in and out of that region, where 40% of the global trade of waterborne crude oil comes through the Strait of Hormuz. So that continues to be an absolute driver on the market. Interestingly enough, the market really seems to be discounting this. When you look at volatility or the skew in volatility, this war began, we just passed the 1-year anniversary of the start of the war, and the volatility did spike. And when I say volatility, I'm talking about implied volatility. This is the assumption that traders are making when they price out options. And options are nothing but insurance policies to protect you against price risk. So those prices for the options for the better part of the past year have been pretty cheap, which tells you that the market is really kind of not paying a lot of respect to the potential disruption to a significant amount of energy that is traded and shipped around the world. Now, that has changed since August. We are starting to see volatility prices, option prices, driven by volatility, moving higher at this point. So the market has finally gotten into pricing in the volatility. So now, more than ever, there's that lack of complacency. And I think some companies, hedging companies, were reticent to hedge given the low volatility environment, despite the headline risk. But now that we're starting to see risk being priced in, it is important now for companies to really start to manage their upside price exposure.
Can I just pick up on that? Because, Stephen, I know you've been in the industry for years, and I have been in a different capacity, but in the energy industry. I am amazed of how the volatility, the risk premiums haven't shot up. Like, why is that? What's neutralizing that type of risk thought process in the marketplace?
Yeah, I'll just back that up. I'm absolutely stunned at the market's complacency up until recently. So the risk is on the supply side. So of course there are two drivers. There's also the demand side. And I do think that is keeping somewhat of a limit to the risk. Now, of course, when I'm talking about demand, your biggest demand driver over the past 5, 6, maybe up to 10 years has been the growth in China. That growth has stalled over the past 10 years. So we're waiting for Godot when it comes to that China demand to return. And as we saw just a few weeks ago with the bazooka policy of quantitative easing that is going on in China, that economy still has a significant amount of trouble. So we're 3 years in waiting for China, that demand to come bounding back, and it hasn't. It doesn't look like it's going to be coming back anytime in the near future. So whereas we have this tremendous amount of risk on the supply side, I do believe it is the demand side, led mainly by China, that is helping to quell some of the spike in volatility.
You've already touched on geopolitical tensions and issues. And I'm wondering if you can share with us that when you're doing energy market forecast, how do you integrate issues like geopolitical issues into a forecast?
Yeah, absolutely. So what's great about quantitative engineering or quantitative analysis, which is where we do all of our price forecasting, is all of the noise that can be in the market has been in the market. What am I talking about? Well, we've always had hurricanes. We've always had war. We've always had catastrophes over the past 20, 30, 40, 50 years when you're looking back at data, depending on the size of your data set. So all of the volatility that has been priced in there gets in there. So we could wrap it around. And as long as we correctly identify the amount of risk, the amount of volatility in the market, then we could adjust our price forecasting. But we have to keep in mind with any sort of mathematical model, it all depends on your inputs. If you put garbage inputs in, you get garbage outputs. And that's where the intuition comes in. So there was an example of this in the natural gas market maybe 5 or 6 years ago, where a natural gas hedge fund dealing solely in options were taking very large outside unprotected positions. They were selling naked calls under the assumption that natural gas prices could go from $3 to $4 to $5 to $6. Now, being around the natural gas market for as long as we've all been, we all know that natural gas is probably the most volatile commodity market of any in the world. So whereas this options trader, this fund manager was just looking at near-term volatility, and at the time of the position was on, natural gas was in a long-term cyclical bear market, given that we had so much of this shale gas that comes to the market. So there was complacency in that position taking and thinking that, no, it's impossible. Now, what has happened is the lack of understanding of the underlying fundamentals. So you can appreciate narrow volatility bands within the given time frame, but you also have to respect the history of the market. And I do believe, and I don't have any inside baseball knowledge on this, but I do believe this was a individual who wrote a book about options trading, so he certainly knew his stuff. He just didn't know the natural gas market. So, or he just didn't respect its volatility. Really, it's knowing the volatility, but also using your intuition and your experience to know that when volatility is cheap, don't underestimate it. It can get expensive and very fast.
Thank you. Interesting answer.
Stephen, you've mentioned the demise of the Outcry trading. It's really eliminated the transparency of deal flow. How does that impact the modern energy trading system that we know today?
Sure, absolutely. It's expanded it greatly. You've had Outcry, and look, I was a floor trader down on the NYMEX. It was strictly a professionals market. So what am I talking about? It was, well, you were either a hedger, you were either a natural gas producer, end user, crude oil producer, refinery, so forth, or you were a large physical trading house like a Glencore, Trafigura, an Enron. So being down on the floor, that gave me great insight to deal flow because I could watch. I know which broker handled Enron's business. I know which broker handled Duke's business. So when I saw those brokers action, I could see with my right physically the deal flow. Now, of course, that has changed. And what that has allowed is for greater efficiencies in the market, being in the cost. There was always that lag of a trading house putting on a position. But by the time he gets on the phone, he calls his floor clerk, that floor clerk calls it into the ring or the trading pit, gets the quote, gets the trade done, and then you reverse that back. there was always slippage in getting on your fills and getting your correct prices. So with the deal flow now electronically, it's cheaper to execute your trades and you're getting better fills with the efficiency. It is also allowed, and adds volatility to the market, it has also allowed retail investors. You can call up your Charles Schwab or a TD Bank and you could open up a commodity trading position. Now, that was always the case. It was very limited. Now, with just a couple of keystrokes, you could open up an account and you yourself could become a crude oil trader or a natural gas trader. And you can cause and you can get yourself into a lot of trouble because the same way that this professional options trader didn't understand the vagaries of the natural gas market and he lost $500 million, $500 billion of other people's money. You yourself could do that very easily. And I give you an example. It happened during COVID in April of 2020. Now, not knowing the physical markets, who would have thought a retail investor trading on your Charles Schwab account, excuse me, who would have thought oil prices could go negative? And commodity prices can go negative because it comes down to storage. So you had a number of investors, traders, who when oil had dropped from $40 a barrel at the beginning of 2020, and by March, when the COVID mitigation dictates all started to tick in, oil prices dropped to $30 a barrel. You had a lot of retail investors who piled in thinking, oh my goodness, I'm buying oil at sub $30 a barrel. It was just worth $40 a barrel 5 weeks ago. I'm going to be rich. But not realizing that if you buy that oil, you are going to have to take delivery of that oil. And the delivery complex in Cushing, Oklahoma, where these contracts are settled, was full. So there was no way you were going to unload this oil. So when it came to expiration, oil went from $20 to 10 to 0 to minus 10 to minus $20 a barrel. So can you imagine being an investor and saying, oh, I bought oil at $20 a barrel and I'm going to sell it back at minus $20 a barrel. So there is that. And there was we would call it doctor and dentist money. Doctors and dentists, they have disposable income. They want to grow their practices. They want to grow their livelihoods. They love to invest. And they love to make bad investments, unfortunately. So it's that dumb money that comes in. And by moving more offline, we have the industry, the professionals, it's more efficient for them to hedge. And two, you have that greater volatility of this dumb money having greater access to the market.
Can I ask you a question on this? And it's not really strictly relevant, but was there an excitement about Outcry trading, and do you miss it?
Yes, I do. Now, I was never a large, big trader. Some of the people that were down on the floor when I was down there, they were giants then and they're giants today. So it was from that aspect, for a young person in their late 20s, it was a tremendous amount of excitement. So I do miss that lifestyle, especially now post-COVID, when many of us don't even go to the office 5 days a week, if at all. So when you're going down to the lower west side of Manhattan every single day, and you're on the floor with a few thousand other people all moving in the same direction, there was clearly that excitement in that. So as a young person, yes, I do miss it. As a person who's not as young as he once was and being able to do the analysis I can, no, I do prefer it this way. So there is a bit of a nostalgia there. I'm so grateful I had the opportunity to experience something that someone in their 20s has no idea what that would be like. So it was that bit of history that I was part of. But I think as we've moved on, no, I don't miss it exactly.
Do you think, just on that, do you think that experience has, for want of a better expression, has made you better at what you do today, having had that sort of, rough and tumble type experience in the markets?
Yeah, absolutely. It gives you a tremendous appreciation from people coming from all walks of life. I always refer to the floor, any floor. I was on the NYMEX. Chicago pits or the old IPE in London. These pits are the crossroads of humanity. So you could be standing next to, and I did, some very influential people that came out from some of the finest universities that have moved on to major positions in politics and so forth. That could be the person standing on your right. The person on your left maybe never even came out of high school or has high school diploma, but he had this ability, this street smart, and call it mental math, to be able to do these very quick calculations and scalp into spreads in and out. So you had people on both sides, and it does give you a great appreciation, especially coming out of university. Like, I grew up in the suburbs of New York, a very kind of a bubble, a sense. I go to university, I come out of university, and then I go down on the floor, and all of a sudden there are people from all walks of life, and so it gives you a greater appreciation of just how important street smarts are, common sense are, and especially now how degraded, especially over the past 2 generations, a college degree really is. It's certainly a walk of life that has made me tougher. It's made me sharper. Again, being a bland, vanilla guy coming out of the suburbs, it certainly was an education, and it certainly has helped propel me in my career all these years.
I have one follow-up question, and it's a real quick one on the same question that asked is, effectively, do you think the market, because of the technology, has become more efficient in its delivery, the marketplace itself? I understand the noise that may occur because of you have these investors that are small-time investors, but because of all the tools and stuff, has it made it more efficient per se? What do you think about that?
Yeah, absolutely. It's availability of data and instant information. Whether you are a scalping, all of these algorithms, these programs that scalp, this is all based on access to very quick information. So that has made it a very dangerous market and very vulnerable to mishaps with data feeds and so forth. But from my own experience, the improvement in technology has helped tremendously. I've been doing this. I've been writing the daily reports, research note, beginning back in 2005, and just how much easier my life has become over the past near 20 years with just in technology of just being able to broadcast or do my research. I've done research and I've broadcast from places all over the world now that I couldn't do 20 years ago. And I'm able to do this because my access to data, and that's all this is. It's all about data analysis and breaking down the numbers. What used to take me probably an hour to perform some of my early algorithms, now it's a matter of seconds, and my decision making is that much crisper right now. So your ability to look at a situation is very important. The way I was taught trading when I was down on the floor is you don't act on a headline. So we'll all get a headline, something out of the Middle East, or, God forbid, the destruction that Milton is about to wreak on the west coast of Florida. We'll get that headline, and you'll get people that will react. A pipeline went down or a platform went down, so forth. They'll react immediately. I was taught to sit back, wait 15, 20 minutes. Let's see how the market reacts. So having that ability to see the way the market reacts. Now, 20 years ago or 25 years ago, when I was on the floor, I could sit and I could watch the market, physically watch the market and how they were reacting to certain events. Early on, you really couldn't do that because the price action and your ability to quickly analyze the data was limited. But now moving forward, 20 years, the access to that gives you a more instantaneous ability to look and wait and make more informed decisions.
Okay, understanding risk and managing it is clearly central to your work. So my question is, what are the most critical elements that businesses often overlook when they're trying to hedge their exposure in energy markets?
Wall Street analysts. I just was on a call yesterday with a very large client in the crude oil market, and I came up with an option program, a collar. So riskless. It was a costless cap collar, but it would lock in potential moves for them. And they were interested. And I've heard this more often than not. When it comes to reporting derivatives, if you have a large gain in one quarter and your hedge lost, which was a good thing, that means your physical commodity did well, they don't want to report it. So many companies are reluctant, I should say their senior management are reluctant to put on hedging programs because they don't want to be deemed on their quarterly earnings calls with investors saying, oh, they've taken a large hit or a large gain. So they're afraid of how Wall Street is going to react to their hedging programs. So the message they're getting from Wall Street is do not hedge, essentially, and take the risk exposure. We'd much prefer that because that could be explained. Oh, a war in Ukraine sent gas prices higher. This is why our refinery business or our processing business didn't do well this quarter. But if that happened on a hedging program, and this has been the mantra all along. I just had this conversation yesterday, but I go back to back in 2009 when 2008, if you recall, oil prices had hit an all-time high, $147 a barrel. That was happened in July of 2008, but by January, oil prices were back below $40 a barrel. And I gave a talk at an event for the airline industry. And I said, okay, this is your opportunity. You should go ahead with your swap dealer or your bank, and you should be locking up as much jet fuel as possible. This is a fantastic opportunity. And the first question I got, I won't mention the airline, and the first question I got is, why should we hedge now, given that oil prices are back where they should be? Should being, a very scary word. And so, of course, we didn't stay at $30 a barrel. So now every time I fly in coach and I can't fit into my chair because of all the cost cutting the airlines do, it really sticks in my craw because they had that opportunity to hedge and they refuse. So, but a lot of it comes down to ignorance when you have executives saying where commodity prices should be, and a lot comes down to Wall Street banks where the top brass at all companies do not want to be exposed and have to explain a derivatives position each quarter. So that's the biggest hurdle that I've come across.
Yeah, that's interesting because often when we're given investment advice adverts, investments may go up and they may go down is a classic sort of strap line with it. But I've come across this on a much lower level with an organisation that in the UK had entered into the electricity pool, and a lot of volatility in pricing there. That they overall were making really good savings over a 12-month period. But they got pushback from the finance director because he couldn't see the predictability in the costs from month to month. Yeah.
Yeah. No, and as I explained to my client, that when you enter in an options position, I mean, you can enter in very risky positions, but they're not traders, they're hedgers. So they're locking in where they know exactly what their cost is going in, but they would rather not deal with it. And I don't blame them at this point because when it comes to hedging commodity risk in large companies, I've dealt with large industrial companies or end users that their hedging program falls under one person or one group, and that's not their sole responsibility. This just comes into their bailiwick. So they might not be absolutely versed into the potential of what a dynamic hedging program could be. So they're going to stay in their lane and they're making the correct decision. So a lot of it is industry specific. Having some knowledge on the way companies hedge their exposure. I can't go into details, but I assure you, you'd be impressed by some companies and you'd be aghast of just how poor some companies protect their exposure in the market, figuring, oh, I could just pass it along to the company or to the customer, or if you're the airline, I could just declare bankruptcy and the federal government will come and bail me out.
Yeah, some of this is about the individual managing their own risk of exposure, isn't it?
Absolutely. Absolutely. So my most dynamic hedgers are my small hedgers in the gasoline and diesel markets. They have greater say. They're very versed, and they're the ones who really take advantage. But the large corporations would rather avoid it just for the headache of having to explain it to Wall Street.
I want to reinforce that, Stephen, because we work with a variety of players, and you're absolutely right. They think they'll pass it on to their customers because they can, which I'm always surprised in that. And then I want to also echo, we work in the agriculture side, and there'll be, I know we're not talking about natural gas, but they'll hedge their position, and it may be a single person that does sophisticated hedging, far more complex than a major corporation. It is really amazing how that works.
Yeah, absolutely. Absolutely. So, yeah, it is amazing to see the inner workings of corporate America.
Stephen, always great to have you on. To end off this episode, what is the biggest takeaway for our listeners?
The biggest takeaway is that to look at the energy markets holistically, that we've had policy now that seems to want to move in one direction. So what we've seen right over the past number of years with the war in Russia, the war in the Middle East, the risk that you have on the supplies or on the demand side with China, that we need a policy that we just can't dictate one energy policy. We have to have a policy that is going to incorporate every aspect, that gives every company or every country its comparative advantage. So the United States has tremendous potential in their comparative advantage. What am I talking about? Their access to cheap energy. Companies in the United States, end users, heavy industrials, have a comparative advantage that up until recently was the envy of the world. Not so much now. So we need to get back to a policy that is all encompassing.
Thanks for that, Stephen. John, what's your biggest takeaway?
Yeah, it's not a detailed one, but it's putting together some of the comments that Stephen made about street smarts and other things like that. And it really comes down to the fact that talking about the models and how you have to have intuition with them. And I think one of the things that worries me is that, no hit at you, Lysandra, but younger people leaving university who perhaps haven't had an exposure to some street smarts might believe that mathematical models can tell it all. And actually there is a place for gut instinct, street smart, intuition. And I think it's really important getting the balance. And I'm guessing to be successful in what Stephen does, you've got to have that balance.
Thanks for that, John. Dave, what's your biggest takeaway?
It's in between what John and Stephen said. I believe we've got a ton of tools that are made available to the marketplace. I'm not convinced that many people are using the tools that they could use, and that they're relying on just being reactive versus proactive, which seems to be a missed opportunity. And so I think when people become more, if I can say, literate or more involved and understand that energy is a way of controlling it with a hedging strategy or a philosophy, good things can happen for corporations. And I just think it seems to be being missed within corporations itself.
Well, Dave, John, Stephen, thank you for your time today.
Really interesting.
Great.
Thank you.
Thank you, everyone. Thank you, Stephen.
Thank you.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn posts.